All right, good afternoon, everybody. My name is Bobby Rains, here for our once every few weeks Investors Observer Members Only Workshop. Welcome. Let's get started. First, we'll talk about what we're going to do today. We'll look at some charts, talk about what else is happening in the market, discuss what sectors and industries are hot right now, and then we'll get into the member-driven content. That includes questions, site demonstrations, pretty much anything those of you who are hearing my voice are interested in hearing me talk about or seeing me demonstrate on the Investors Observer website. As always, you can submit questions ahead of time. Just send us an email using the help button on the website, mention workshop, or when you get that invitation that says, hey, there's a workshop coming up, you can just reply to that also. All right, so to the charts. All right, the S&P 500, as I'm sure everybody is well aware, hit its high for 2022 on roughly the first or second day of trading last year. So yeah, we're up from the lows. Our last workshop was about here, so we did not get the Santa Claus rally that I thought we might get, but we also didn't really go any further down, and we're actually up a little bit since then. Which is, better than the alternative. All right, so over on the NASDAQ, it's pretty similar looking chart. I expect we'll hit a little bit of resistance when we get up to this level. I should probably draw another line in here. But yeah, we'll see. Earnings, we've got earnings and the CPI coming out. Well, CPI is tomorrow, and then earnings start probably tomorrow after the close in earnest for the next couple of weeks. So those will be interesting and maybe bigger drivers than anything technical for at least a little while. All right, over in small caps, we got pretty close to a Santa Claus rally in terms of being really nicely up since the last workshop, since Christmas, or a couple days before Christmas anyway. So that's nice. The small caps had kind of an interesting pandemic, really. They were kind of range bound when other things were rallying, and then fell back out of that range. And I'd like to hope we'll be able to get back, back on track and set some new highs, because it's been kind of a long time since the Russell set a new high. All right, the S&P 500 versus the equal weight. This is interesting. It doesn't look like the regular cap-weighted version, which is the blue line here, made up much ground here recently. You can see they both went up. The next slide is actually more interesting in terms of who's been rallying to start the year. But yeah, it's a little bit interesting that what we're seeing here. And the reason I like this chart is the S&P 500 gets kind of distorted by the 5 or 6 big tech companies. Although I guess by market cap they're not as big as they used to be. And so if you look at the equal weight versus the cap weighted version, you get a sort of a picture of how much of the movement in the index is those big 5 or 6 tech companies at the top, and then the other 494 stocks at the rest. And so you can see here, it seems like it's been pretty even, at least for the last week or so into 2023. All right, growth versus value is a little bit more interesting. Growth, which is blue, lagged pretty badly in 2022. But it has had a better start to 2023 so far. Now, some of this is things like, I don't know if that they're necessarily included in this particular ETF that I used for this chart, but you've seen things like Bed Bath & Beyond come up big, and some of the meme stocks are back to rallying again. I wouldn't necessarily include those in any kind of narrative I was trying to construct around this, but it is a little bit interesting. It seems like some of it is probably just people buying the things that lost the most in 2022. Is certainly a little bit of it. Some of it's probably some rebalancing. you have this kind of a divergence between two sets of stocks that people tend to like to have some fixed allocation toward. You'll get some selling in the one and some buying in the other. So that's kind of what I think is going on there. Some of it could be the Fed seemingly softening its tone a little bit on interest rates, although the amount of softening they're really doing is maybe less than some people might have expected. And it's also uncertain how much it's actually, right, like raising rates slower is not the same as lowering rates, certainly. So it's a little bit difficult to tell what exactly those things mean there. But those are all some reasons that tech stocks could be going up here. Mostly these are tech stocks. The growth is a lot of younger companies that tend to be fast growing, which in 2023 is a lot of tech stuff. All right, so the sectors and industries that are hot right now. This energy section is going to get burned into my screen here if it stays at the top much longer. It's been at the top for, I think, almost all of 2022, and thermal coal has been leading the way. A lot of that is because of disruptions in natural gas globally with the Russia's invasion of Ukraine. Coal is the sort of easiest replacement for natural gas as far as electricity generation goes. And then oil and gas drilling and oil and gas integrated. That's, pretty much it's been drilling, oil and gas drilling, and then some other oil and gas play these three have been kind of up here for, it feels like all of 2022. And 2023 isn't starting much differently. Utilities, similarly, they remain in that second spot as far as the top sector. And it's diversified utilities and then water and electric. These are kind of interesting. They tend to be, right, that's a group that tends to be a sort of flight to safety play. They pay a dividend. Right, nobody is, there's not a lot of growth potential there. But they are mostly pretty steady companies, right? Like nobody's expecting them to go away anytime soon. So those end up being a lot less volatile than, say, energy or some of the other things. But again, we're looking at another thing that I feel like I said for all of 2022 is we're looking at a sort of interesting story with this list, because energy is a thing that you expect to do well when the economy is growing and booming. And utilities are the kind of stocks that people buy when they're worried about the safety of the market, because like I said, they tend to be pretty boring. They pay a dividend, and that's mostly all you can say for them. There's not a lot of exciting growth potential there. Consumer defensive is another sort of flight to safety kind of play. Confectioners is stuff like Hershey's and Mondelez, and the tobacco. Tobacco is whatever the opposite of a growth industry is. It seems to be shrinking. But again, the stocks are relatively stable. They pay a nice dividend. And non-alcoholic beverages, I guess there's been some change there in terms of Coke is selling less actual soda and more, water and juice than they were some number of years ago. But people can only drink so much liquid in a day, and they're only willing to buy so much of it. So it's not an exciting growth kind of industry. It's sort of steady things that people need and continue to buy, even in a recession, are the kinds of things that we're seeing on the list. And then, the next category is industrials, infrastructure operations, conglomerates, airports and air services. Again, that's growing economy stuff, right? Infrastructure operations tend to be kind of underutilized when the economy is weak or slow. And since an infrastructure operation, like a port or a rail yard or what have you, anything that's sort of infrastructure, especially transportation infrastructure, requires a lot of capital investment. And so if that's being underutilized, a lot of times you're burning cash to make bond payments on those things because they're being underutilized. So that those stocks are doing well suggests that they're not, right? Like we know airports are pretty full, and industrial conglomerates are another thing that again, right, like people want stuff. If you're making stuff and selling it and finding that to be good business, it seems like the economy is probably not doing too badly. Especially because in industrials and conglomerates, what you're looking at a lot of times is bigger things, right? Like toy makers or somewhere else, right? A lot of the smaller consumer goods are in different sectors. So industrial conglomerates tend to be sort of business services. And so if they're doing well, businesses are generally tend to be doing relatively well. And then basic materials. Coking coal is used in making steel, copper, other precious metals in mining. All of these, again, are things that tend to do well in growing economies. So we still the same mixed bag that we've been talking about for a long time here in terms of like, what is the market telling us about the economy? It's really hard to tell. People are worried about a recession, but also some things that we would expect to be signs of a growing economy are moving pretty fast. And let's stop real quick and go over to the website. You can find this list if you go to stocks and then sector and industry. And I pull that list from the short-term technical. That's a look at how the stocks in those sectors and industries have done over the last, call it 30 days or so. Certainly, if you want a longer view, the long-term technical looks out closer to 100, 200 days, something like that. Analyst ranking is how the analysts feel about it. Valuation is exactly what it sounds like. Sentiment is what's been moving around in the last 5 days. Fundamental is, fundamental analysis. It's pretty, the way most analysts would rank things. And then the overall score just averages the fundamental short-term and long-term technical scores. All right, so that's that. All right, what else is going on? Still a lot of people paying a lot of attention to the Federal Reserve. December's interest rate hike was 50 basis points instead of 75. A lot of people are expecting them to go to 25 basis point increments going forward. That's a quarter of a percentage point. The terminal rate, which is how high rates will ultimately go in this hiking cycle, sort of remains a question. I think a lot of people are expecting something a little bit above 5. I've seen as high as like 5.5. And the Fed keeps saying rates are likely to remain elevated for a while, but how long, right? Like what constitutes a while is sort of unknown. And then the other thing that will be interesting to watch is the data shows that inflation is in fact slowing, or price increases, which inflation is slowing. Some questions are, is it for real? Like, is it a sustained decline, or are there just, some year-over-year effects that are showing up in the data? And then also, will the Federal Reserve trust that the economy is cooling off without a rise in unemployment? If inflation gets back to somewhere where the Fed is comfortable with it without an increase in unemployment, will they stop raising rates? Or are they going to keep raising rates and keep them high until there's some slip in the employment sector? And the danger there is obviously that in the same way that inflation can sort of get away from you, once you start losing jobs at a high rate, that also can get away from you, and you rarely see just a small increase in unemployment. I mean, there are certainly some seasonal factors and things like that happen, but you rarely see, say, just a 1% increase in unemployment without a little bit more to come after that. So it'll be interesting to see sort of how the Fed handles all of that. But generally, like I said, the economic data is generally pretty good. The CPI tomorrow will probably be a big volatility maker in either direction. To some degree, people will see the story that they want to see, but I think a big surprise in either direction will probably move the market, sort of in the opposite direction, right? If inflation comes in hotter than people are expecting, that would probably move stocks down. If it comes in lower than people are expecting, it'll probably move stocks up. If it comes in right in line, I expect a lot of people to sort of write their own narrative and move stocks whatever way sort of the majority wants them to go. But yeah, what we're seeing is in a lot of cases, most data shows some sort of softening, but nothing to me that really looks like a recession. Like if you look at the PMIs and various other sort of ways to slice the economy and look at economic activity, there's certainly been a little bit of slowing, but nothing that really indicates a recession is right around the corner. It's possible people could talk themselves into having a recession, but it doesn't necessarily have to happen, I don't think. The other big thing on the radar here is earnings season. That starts basically the end of this week with banks and some airlines, and then gets really heavy the following week and the couple weeks after that. Some companies have cut their forward guidance, which is essentially what they say they're expecting to make. Analysts are also cutting their estimates. Potentially sets up a situation where there are a lot of beats, but it doesn't move the market much because there may be small beats, or you kind of, so a company comes out 2 weeks ago and says, hey, we're going to make less money than we thought we were, and then they deliver a slightly higher amount of money next week. Maybe the stock goes back to roughly where it was before. Those sorts of things don't tend to have a long-term effect on stock prices unless there's some big, what you would really look for in terms of a blowout and something that's likely to spark some kind of a rally is, a company beats earnings, they raise their guidance in forward quarters, and generally just seem to be sort of hitting on all cylinders. And I don't expect a lot of that this time around, largely because I feel like there's a lot of uncertainty around interest rates and a bunch of other things, and a lot of companies got away from guidance in the pandemic. I don't think all the ones that stopped giving guidance have even brought it back. And it seems to be sort of less specific, and people are providing wider ranges, or maybe not providing as many quarters of guidance as they had before. That may be good because people aren't trying to necessarily hit an earnings number, that they tossed out 6 months ago. Now they're maybe managing the business for long-term success as opposed to trying to hit a number every quarter. But it's a little bit harder to predict what the market is going to do in this sort of new guidance doesn't mean quite as much sort of regime. Yeah, I kind of expect the weakness in tech earnings to continue. A lot of the tech companies, you think about Google, Facebook, Netflix has just gotten into the advertising business. A lot of those are advertising-based businesses. And a lot of them were advertising for other advertising-based businesses. And by that, I mean, think about like how many times on Facebook or various other places on the internet, especially on your phone, you've seen ads in an app to download a different app. Right? Like it's kind of ads all the way down at a certain point, right? Like company A is paying for itself by selling ads to company B, which is paying for itself by selling ads to other companies, right? At a certain point, that sort of circle has to slow down, especially because a lot of those companies were losing money, right? So especially when interest rates start to go higher and people reconsider their investments, money-losing companies often have to pay a lot more for things, and yeah, they cut the marketing budget, it turns out. Even things like Salesforce that aren't directly ad-related, it turns out that Salesforce is mostly a tool used by marketing. So if people are cutting their marketing budgets, they may look at getting fewer Salesforce licenses or something like that. All right, on to the questions. So Charles said he noticed that most of the best stocks in the farming sector had low fundamental scores relative to other stocks. Is this a byproduct of the last couple of years, or is it just an inherent part of farming? I think it's a little bit of both. Some of those stocks have done fairly well over the last couple of years, but also it is kind of an inherent part of farming. Farming is very much a commodity business. There's no real product differentiation. I mean, if you think about the things that come from farms, there aren't a lot of brand names, right? Like corn is kind of corn. I guess there are a few branded eggs, but I don't, yeah, I would be hard pressed to tell you the difference or name a single person I know that has a preferred brand of eggs. So that means that there's very little competition on price, right? Like Coke and Pepsi can compete, but also if somebody prefers Coke over Pepsi, they may be willing to pay a little bit more. Right? Like probably not too much because they're very similar, but maybe some because there is some product differentiation. There's some brand value there. But if everything is just corn, if somebody, if the farmer next to you finds a way to grow corn cheaper and so he cuts his price, well, you better find a way to cut corn cheaper or to grow corn cheaper because you're not going to be able to sell it at your old price. You're going to have to sell it at his price now because that's the price of corn. So yeah, you basically only grow margins on production costs, but there are, right, the inputs are also commodities, right? So it takes roughly 2.6 pounds of corn to make a pound of chicken, and a pound of corn takes roughly a pound of nitrogen fertilizer, which takes some amount of usually natural gas because they make fertilizer using what's called the Haber-Bosch process. Anyway, all of this is to say that, yeah, the things you're in control of as a farmer are a very, very narrow slice of things. You're also exposed to weather and other global events. It's a business that's very not easy to model or plan ahead for. So margins are externally, all you can really ramp up and down is how much you produce. And even then you're exposed to the weather, right? Like if it's dry or if it's wet or something like that, kind of, you're going to produce less. And that's not because you wanted to, it's just because it happens. But what you see a lot of time in agriculture is the sort of boom and bust commodity cycle, right? You increase production when margins are high, kind of flood the market a little bit, those margins collapse, you cut production, lather, rinse, repeat. Yeah, I mean, some of these companies do pay like a dividend and, like they're not likely to disappear, but they're not really growth stories, which is a lot of what the fundamental score is about, right? They're all sort of mildly profitable. Here's the list of the top few that Charles provided. I mean, a lot of these companies are sort of mildly profitable. Some of them haven't been profitable the last couple of quarters. They're not growing particularly fast either. It's really just, it's kind of a function of how agriculture is. It's a difficult business without a lot of margins or anything like that. So, and if you, the things you notice that are missing here are, well, Calm is cow Maine. They make eggs. The meat processors, like say your Tysons and your Hormels, have actually gotten out of the farming part of it. They actually have a contract with a chicken farmer to buy birds and process them. But the actual, like a lot of the other pieces, they have kind of outsourced to someone else. So they've sort of changed their business model to deal with to have a little bit fewer of these risks here now. And so those are they tend to trade a little bit differently than some of the actual like pulling things out of the ground to grow them commodities. All right, and then Marcin had a question about an ETF to park money in, like for rare earth metals. Right, like copper, a lot of people have, but nickel is growing pretty fast, maybe faster than lithium. And yeah, all these new semiconductor plants growing online are probably going to need some of them. I think part of it kind of depends on the definition of park. Like small emerging commodity-based industries can be pretty volatile, so I wouldn't be like, oh, well, here's a safe place to put a bunch of my portfolio. But in terms of putting a small piece of a portfolio, something like this is certainly attractive. It absolutely seems like a growth opportunity. The things that I would kind of look at are, do you have this exposure somewhere else in your portfolio? Like a lot of the companies that are doing rare earth metals are included to some degree in some metals and mining ETFs. Some of them may also be in international ETFs because a lot of companies are based in China or somewhere else offshore. And yeah, the risks are here. The biggest names seem to have a lot of China exposure, which, if you think about what happened with like the Chinese education stocks some number of months ago, they all got whacked. Several other things like that, like investing in China is a little bit risky because of the politics of China. A lot of the non-China companies are also pretty small. I think the thesis here is generally sound in terms of investing things that are going to be in more demand in the future. I'm also a little bit not sure. Nickel and lithium aren't necessarily in the rare earth category. Yeah, rare earths tend to be a different piece of the periodic table. Nickel and lithium are used in a lot of industrial things anyway, but they are especially used right now. The big growth in both of those is batteries, for electric cars and various other things. That's the big demand for those right now. And I think if you think back to the, let me just click back to my slides here. Yeah, other precious metals in mining might be stuff like silver and gold. But yeah, any sort of a lot of the metal and mining ETFs have some exposure to nickel or lithium. All right, other questions. If you have questions, go ahead and just put them in the box there, and I'll get to them as they come in. The first question we have is from James. He says, "What is your opinion of cannabis stocks for 2023?" Yeah, that's a good question, James. They really got beat up pretty bad in 2022. I don't have. Yeah, it's an interesting sector. It certainly seems like a place where there could be some growth. I think the companies in the cannabis, broadly in the cannabis sector, are, a lot of them are doing a lot of different things. So one thing I would point you to is all the stuff I just said about farming applies to some slice of the cannabis stocks, right? If you're growing plants to sell, you're competing with everybody else who is growing that plant to sell. And now, certainly in cannabis, there are some geographical differences. Cannabis is a thing that doesn't cross international borders particularly easily, and things like that. So there may be some sort of what people would call a moat in that regard. In terms of people who can produce cannabis in certain geographies that other companies may not have access to, things like that. But generally, growing plants is growing plants, and that tends to be a pretty low margin business. Now, it's possible early on that it could be higher margin than it will be once it becomes sort of a more established industry as it really starts growing. But those companies I sort of don't have a great feeling about. I think the best thing for people holding some of those stocks right now is somebody will probably try to come in and buy those assets, and you may get some premium to where they're trading now. And some of the other companies are a little more interesting, right? Companies that are making products, whether it's in the biotech space or the nutritional supplement space, or just the, people like to get high kind of space. Those I think are more interesting. You definitely see, as there are pushes toward legalization in various states or decriminalization in various states, you see some things there. They could be interesting. Yeah, I don't think. Yeah, I don't have an outlook for the whole cannabis sector because, you see these lists of cannabis stocks, and it's everything from people growing pot to biotech firms to people include Scott's Miracle-Gro in the cannabis sector a lot. Those are all things that are exposed, but it's real difficult to know who exactly the winners are there. And a lot of it depends on politics in various places, which are very hard to predict. I'm not over optimistic about legalization in the United States this year, which I think would be a big catalyst for those stocks, but I'm not I'm not sure what it would take to get it to happen. I feel like if it was going to happen by executive order, it probably would have happened already. And I don't really see a lot of things getting through Congress with the houses divided the way they are. All right, so Derek says, I'm looking to invest in an S&P index fund with one of the top companies, such as Fidelity, Schwab, or Vanguard. Aside from the fees, are they all going to perform the same as they mirror the S&P? Pretty much, they will. The Vanguard is a big one. I think that's VOO. The other biggest one is SPY, in terms of ETFs, which I tend to prefer ETFs, especially for stuff like that, to mutual funds, just for like reasons of liquidity and portability. And Vanguard in particular has done some interesting things the way they structure their ETFs, so that the taxes on certain things work out a little bit more favorably for you. I know Fidelity and Schwab, I think Schwab probably has an ETF. I'm sure Fidelity has a mutual fund. I don't know if they have an ETF offhand. But yeah, the performance will all be basically the same. The big difference is the fees. And then after that, the thing you would want to consider is, for a day trader, which it doesn't sound like you are, the SPY and the VOO are the big ones. So they're going to have the most liquidity. They're going to have the tightest bid-ask spreads and things like that. If you're looking to trade options on top of one of those, the SPY just has so much more liquidity in the options that, again, the bid-ask spreads are narrower and things like that. But generally, since they all, as long as it's a classic, market cap weighted S&P 500 index fund, they're all going to be, within a couple pennies of each other in terms of tracking the performance. They may not be the same price necessarily, because a lot of times they start at a different price or whatever, but they'll all perform pretty closely over time. So Clifford says Feds are going to increase the rate 25 more points in February. What areas will be affected the most? Yeah, 25 is sort of the consensus. I don't know necessarily that is what's going to happen, or that'll be the last increase. Also, after raising from basically 0 to whatever it is now, 4.5, 4 3/4 or something, over the last basically 12 months, I'm not really sure how much another 25 basis points changes for anything, right? I think really where it gets interesting is what people think rates are going to be in the future. A lot of things are indexed to like the 10-year treasury, which is, right, so if you think the Fed controls an overnight rate and it's at 4 and whatever, well, a 10-year note is just several thousand overnight periods, right? So what the 10-year should be, for the most part, is the market's expectation of the average overnight rate over the next 10 years. And the fact that those are a little bit inverted, I think, right now is kind of interesting. It suggests that people think rates are higher than whatever the neutral rate is, and expect some cuts over the next 10 years, which, yeah, it turns out also expect rate cuts over the next 10 years. The next 12 months, I'm less optimistic about cuts. Right now, the banks are sort of, well, the banks are in a weird spot right now. A lot of banking is based off of economic activity and deal making. And so when the Fed comes in and tries to tighten, monetary conditions, fewer people go to market with IPOs, fewer people have follow-on stock offerings. There's less underwriting, and some of that, there's a little bit less M&A because borrowing is less. So a little bit less of that activity that sort of your big investment banks deal in. Your Goldman Sachs's and Morgan Stanley's are the two biggest names there. I expect them to be sort of hurt the most by that. But the traditional sort of retail banks tend to do better because they will absolutely hike lending rates to keep up with the Fed, and they tend to lag a little bit on savings rates. So they're probably looking at wider interest spreads right now. So I think, the sort of banks that I would be looking at to have better quarters than the others are the banks that have a lower mix of investment banking business and a higher mix of that, just retail, making home and business loans and holding on to deposits for people kind of business, and less of the, like I said, the underwriting and the advisory sort of business. But other than that, I don't think 25 basis points makes that much difference, especially after we did whatever 450 basis points in the last 12 months. All right, if there are more questions, go ahead and throw them in the box there. Richard, is there anything in particular you want to see? I'm happy to go over whatever on the website, but okay, stocks or options. All right. So yeah, as far as tools go in the options land, the big one is the screener. But coming out of the screener are 3 featured trades every day. These are going to be covered calls or occasionally a short put because it's a pretty similar trade. Excuse me. Yeah, and so there's 3 of these every day, and the personalized trades. If you just want a couple of things, you can find there's 9 categories here. Conservative, balanced, and aggressive for each of covered calls and puts, diagonal spreads, and vertical spreads. And so depending on what kind of trader you are in terms of your risk tolerance or, option strategy, those are pretty good to go there. If there's a particular stock you're interested in, obviously you can just type in a ticker, go to options trades, and see what our picks for the day are as far as that goes. But if you're a little less, if you want something a little more esoteric or want to see more choices or something like that, you can go here. You should have some saved screens that you can look at in terms of just something to get you started. But also, right, so if you want to start with covered calls, you can start there, and then let's say you want to do things that are, let's say, a month or less. You can click that. You can also, you can set a minimum number of days if you want. Most people tend to want shorter trades as opposed to longer, so I don't really use a minimum number of days. And then, for covered calls, I usually like an annualized return rate of 15. Depending on market conditions, sometimes I bump that to like 17 or 20. But that also helps get rid of some of the longer ones and things like that. And then, risk management, it's covered calls, so you have to buy 100 shares of stock. So I typically don't want anything that's going to be above about $70 or $80 a share. I prefer to keep it lower than that if I could, but it's gotten harder. Overall score, this is a neutral to sort of bullish position, so I usually use like a 45 or a 50 here. Key rating is how well the position can be, let's say, defended. So if you needed to, say, roll the call or do something else, how easy is it to make that trade? And so what we look at there is things like liquidity, how close the strikes are, how far away the strike prices are, and things like that. So keys, I'll usually look for, say, a minimum of 4. And then I want things that expire before earnings. Some people like to sell calls that go over the earnings period because you get a, there's more volatility, so you get a bigger chunk of option premium there, but I kind of prefer not to do that because there's a lot of uncertainty about the extra stock. So once you do that, we went from 3,000 and something down to 70. And here you can sort by the columns, right? So you can say, just put all the 5s at the top. And then if you hold down the shift key on your keyboard and click a column header, it will do a second level of sort. So you can see the highest overall score and the highest key ratings. And you end up with something like this. And then from here, I usually go through and look for things that I'm interested in or find attractive, or like the length of time or the price or something like that. But that's usually about where I start, is something like that. All right. All right, so Clifford said, what are your sentiments on growth or growth stocks for 2023? Growth generally, I think, is going to be a hard sell. I mean, we looked at that chart and I saw it bouncing back a little bit, and I think that's good. I think some of that's technical and some of it's rebalancing. But growth tends to struggle in a higher rate environment. A lot of those companies tend to be unprofitable, which means they're tapping the market for financing, and higher interest rates, generally means that money is more expensive, whether you're selling stock or bonds or taking loans. Money tends to be more expensive, so it's just harder to fund growth unprofitably in this kind of rate environment. So I don't expect a big turnaround there. I think some things, maybe got a little oversold, and we could see some rallies here and there. But yeah, generally, I don't think a big pivot to growth right now is necessarily going to turn out super well. All right, so Charles said, what are your thoughts on energy and healthcare? Any other sectors you might think might be beating the indices? Energy has been strong for a long time. This is why I'm not a short-term trader. I've kind of thought it maybe would have run out of room to run for a while. Healthcare is interesting. Well, let's stay on energy for a second before I pivot to healthcare. Yeah, I mean, the federal government is going to be buying oil at some price to put back in the Strategic Petroleum Reserve. The global price seems likely to stay pretty high. So I think there's a decent chance that energy stocks will do okay. I don't know that they'll post another year like they did in 2001 or 2002. But I think they'll probably be okay. It still seems like we're a little, maybe not short, but at least very tight in terms of how much oil we're producing compared to the consumption of oil. So I think that might be a reasonable thought there, but I don't know if it's going to necessarily outperform huge. A lot of those companies, especially if you look at the oil majors, pay a decent dividend even after the run up they've had. So that's another reason why you might be interested in those. Healthcare is sort of more complicated. Healthcare got beat up pretty bad last year. Granted, a lot of that is drugs and things like that had a just outstanding 2021. But now might be the time to try to go sort of, bargain hunting through there. I don't know that I would just buy a healthcare ETF just because the healthcare sector is really wide in terms of having everything from like biotechs to, right, like operating a hospital. Like operating a hospital is not going to be necessarily super profitable, especially now that a lot of the hospitals and insurance companies have sort of combined, and you got some weird stuff going on there. But healthcare, I think, is certainly a place where you you might be interested in doing some bargain hunting, just because that whole sector got hurt pretty badly in 2022. All right, let's see what else we got here. All right, so Kavork says, who's going to manage those option trades? Any option trades you find in the screener or the featured and personalized trades, or just on the single stock page, is up to you to manage. We can generally give you some sort of general guidance about how strategies work and things like that. But as we're not a financial advisor, individual investment advice is not really something that we're allowed to do. But if you're just curious about like, how do I do this? First of all, check the help center, but also you can send us an email, or I'm happy to talk about these things in the workshops also. Related, Charles asked, any ideas when you'll feel more comfortable getting back into creating the managed option trades? So those are the trades that are in the options portfolios, which show up on the top of the options dashboard, as well as on the portfolio page. And here we're still looking. I want to get the CPI but behind me tomorrow, just because the volatility that's going to come with that. But I'm hoping as we get into 2023, even if we don't get a big rally in the market, we'll have less or fewer big swings based on CPI and things like that. Those are the things that are really hard to trade around, is when the whole market just goes up and down by a couple hundred points in a day. You can be right about the stock and still just not do well with this kind of options trading. So that's really what we're kind of looking for there, is something where we feel like we can do do something and actually have good results for people. Can I integrate IO options with my broker, E-Trade, Vanguard, or Fidelity? You can make all of these trades with any broker. We don't currently, like in the My Portfolio feature or things like that, we don't currently support options. That's the thing we're hoping to add at some point in the future. Don't have a time frame there. But these trades you can absolutely do at any broker. Derek, what's the difference between the SPY ETF and SPYG growth? So the SPY ETF is the S&P 500. I went to the wrong place. SPYG, I believe, is like just the growth stocks from the S&P 500. That's interesting. That may be the wrong description. Yeah, I don't think the S&P 500 growth ETF tracks the Bloomberg MBS index. So I think that may be the wrong description there. But yeah, I think it's just the growth stocks from the S&P 500 in the index. Yes, the session is being recorded. We'll post a video of it tomorrow, and we'll usually send you an email when it's up. It'll also show up in the featured section for a little while, and then it'll show up on the personal finance tab here afterwards. And you can go back and look at past workshops as far as that goes also. So Michael says, how do I find February monthly options for XOM? So the monthly options are just the options that expire on the third Friday. And since we're inside of 6 weeks, I don't, let's see, that's January, and that's, yeah. None of our trades today on Exxon are using the February call. I'm not 100% sure why you'd be interested in that specific expiration, but yeah, it's the monthly option is just the one that expires on the third Friday. So Jim says, what are your thoughts on setting up bull call spreads? They work basically the same as the credit spreads. Sometimes if you look and compare the net premiums between the two options, you can be a little higher on the bearish side or a little higher on the bullish side. The thing about bull call spreads is you have some options assignment risk because you have a short call there. And so if a stock is going to pay a dividend, sometimes your sold call can be assigned early, and then you are out the dividend, which can, depending on the stock and how you set up the trade, can be more than the target profit on the trade. And that's most of the reason we mostly do the bull put spreads here, is just because trying to trade those around the dividends gets to be kind of a hassle, and it's easier just to use the put side because the prices end up being basically the same. Occasionally you can find a couple of pennies here or there by going puts over calls. But yeah, it's not usually a significant difference. Okay, so Ronnie pasted in here a description for SpyG from somewhere else. And yeah, it tracks the S&P 500 growth index, which is just a large cap growth stocks, basically. Yeah, thank you for that, Ronnie. All right, so when doing options, what works best, or what is buy open, buy to close, sell to open, sell to close? Yeah, so those are 4 different things. If you're opening a position, you have to do either buy to open or sell to open. You can't start with buy to close, because close means in the position. So the simplest sort of option trade to think about is just buying an option, whether it's a call or a put. You just buy it, and that would be a buy to open. And then when you're done with that option, you decide you want to sell it, then you would do a sell to close. We are also hoping to add that strategy sometime soon. The simplest thing we have here is probably something like the covered call. In that case, what you do is you buy the stock and sell a call against it. And so in that case, you start with sell to open, and then that option would be either exercised or assigned or expired. Or if you decide you're done with the option, you can sell it to close. So buy to open, sell to close, or sell to open, buy to close. You have to do the opposite of whatever it was to get out, because that's how that works. You can't start with a buy to close. Let's see, we don't currently have text alerts. We do send emails for those portfolio trades that I mentioned. We're hoping to get back into making more of, but that's the only thing we provide an active notification about. And yeah, I guess we do send out some other things by email, but yeah, that's the only one like that where we send any sort of exit guidance. All right, well, I don't see any more questions coming in, so I'll go ahead and wrap up. Like I said, this is being recorded. We'll send out a link to the video tomorrow. It's just a YouTube video. You don't have to download anything or anything like that. Just YouTube. It shows up on the website. Yeah, you can contact us anytime with this help button. It's just send us an email. We usually get back to them pretty quickly. Mention workshop if you want me to, put stuff on a slide and talk about it here. Otherwise, we'll just send you an email with what we hope is the answer to your question. Yeah, I think that's it. Our next workshop will be in 3 weeks, which looks like it is about February the 1st. So yeah, it's almost February already, and yeah. All right, anyway, thank you for subscribing to Investors Observer. Thank you for listening to me talk for almost an hour today, and I will talk to you again soon.